you have a scarcity of metal that disincentivizes the primary producers of that metal. If that's not an exquisite irony, if that is not a terrible, perverse incentive and a perverse outcome, I don't know what is. As an economist, I can't really think of anything too much worse than that.
Hey guys, Ralph here from the Endgame Investor, and you might remember back in October when silver was in backwardation briefly for about a day, day and a half. People were saying it was in backwardation for longer than that, but I disputed that because what was happening was that the spot price in London was trading higher than the futures price in New York, and that is not exactly backwardation, but for about one day, maybe 36 hours, silver was actually in backwardation on a New York to New York basis. And Keith Weiner just came out with a video. Keith Weiner is the CEO of Monetary Metals, where you can lease your gold and silver out for a yield in gold and silver terms. I have some of my stacks earning with Monetary Metals, and if you want to participate in their leases, which can get you between 3 and 4% on your gold and silver holdings, link in the description below. He came out with a video explaining why his lease rates are not the same as the lease rates offered by bullion banks. And when you hear headlines like the lease rate for silver has gone up because of backwardation, it has nothing to do with his market. But he did say in that video, and he did explain how silver backwardation and, of course, gold backwardation ends the dollar system through a perverse incentive. I'll show you that clip. It's about 1 minute long, but what I will do is summarize it first and say that if silver is in backwardation, meaning that spot silver prices in New York are more expensive than future silver prices in New York, then silver refiners cannot hedge their inventory because they would have to sell forward for cheaper than they bought the silver for. That would make them lose money, and so they are incentivized to stop production or refining of silver in the case of silver backwardation, and that shrinks the supply even further and drives prices higher. What is the only thing that can get you out of temporary silver backwardation? It's that you hope that people with already refined silver put so much of it on the market because the price is so high that it overwhelms the backwardation that is happening and brings the market back into contango. Well, here is Keith explaining this in his terms.
They bought it when silver is $52, and then a week later when they refine it and they're ready to sell it, the price drops to $48. They can't take a $4 loss. The refining margins are nowhere near $4. So they hedge it. Okay, normally hedging means you sell it forward, and normally forward is a higher price than spot. And so there's actually a little bit of profit on the hedge, for a refiner. Now, you take this $2.15 backwardation. That meant the cost of the hedge was $2.15 an ounce on $50 is, what does that work out to? 4% or 4.5% roughly. So if the cost of hedging is 4.5% for a refiner who's hoping to make a margin of probably less than 1%, that's a real problem. And so the refiners said, no mas. And so you have this perversity. You have a scarcity of metal that disincentivizes the primary producers of that metal. If that's not an exquisite irony, if that is not a terrible, perverse incentive and a perverse outcome, I don't know what is. As an economist, I can't really think of anything too much worse than that.
One day, gold and silver will enter backwardation, but nobody will sell their gold or silver, or not enough people will sell their gold or silver for dollars in order to bring it out of backwardation. It will be locked in there, and prices will just keep going higher and higher and higher, which will further disincentivize refiners to produce gold and silver, which will make the supply that is available for selling even lower and make the backwardation even more extreme. This will lead to the end of the dollar system at some point soon.
When will then be now? Soon.
And here I wanted to get into one academic disagreement that Keith and I have. It's fine, we are colleagues. And he might be right about this, I might be right about it, but basically the point is that Keith does not believe that gold to silver ratio will reach 15 to 1, whereas I do. I don't know how long it's going to be there, but I do think it is going to happen. Keith thinks that the conditions that allowed for a 15 to 1 ratio back then do not apply now. I don't know exactly what he means, but I'm going to try to make my case that Gold and silver permanent backwardation will necessarily lead to a 15-to-1 ratio. How long? I don't know, but I think is going to happen. Here are the slides, and this is my case. This is an article from the Wall Street Journal and two paragraphs or two sentences from that article, which are key. Japan is outspending. Bond markets seem nervous about picking up the tab. Japan's prime minister plans to rely on bonds for the $135 billion stimulus package. Yoshihiko Noda, leader of the opposition Constitutional Democratic Party of Japan, said in the parliamentary session that markets are raising an alarm against reckless fiscal spending, including this latest economic package. He warned that Japan could face a crisis similar to the Truss moment in the UK in 2022, caused by then Prime Minister Liz Truss's plan for big tax cuts, which led to a sudden spike in gilt yields and a plunge in the pound. Well, we've seen Japan's 10-year yield rising pretty relentlessly over the last few weeks. You can see here, this I added in at the bottom. This is not part of the article. This is a graph from Trading Economics that shows the long-term chart of the 10-year Japanese government bond yield. We are at 1.965, and you can see this is the final resistance level going back all the way to the Asian financial crisis of 1998. And above this resistance level, there is space. Outer space, and that's a technical term for outer space, I guess.
Space, the final frontier.
Space, the final frontier.
In the 90s, we saw that the Japanese government bond yield went from about 8% all the way down to where it is now at 2%. So once we break this yield, this resistance, rather.
Resistance is futile.
Yields could go pretty much anywhere between 2 and 8 pretty quickly. And we all know, what does this have to do with gold and silver backwardation? Well, we know that central banks are so full of debt because they buy their own government's debt. And that's what we mean when we say that fiat currencies, which are not exactly fiat, they are really gold and silver currencies with a whole bunch of debt inflation on top of them. When the debt goes away because the value of debt is falling, because the yields are rising, that's when gold and silver reassert themselves as monetary commodities, primarily gold. But then what happens when the value of the bonds backing the money falls because yields are rising? Well, gold becomes too expensive. And that's why the public says, well, I can't get any gold. What I can do is maybe sell my labor for some silver. And that's why silver's price rises relative to gold when these bonds fall in value and eventually reach zero because the currencies that they are payable in become worthless. Let's go to the next slide. This is a very similar article that came out in Bloomberg today. QE may be needed if market queries new Fed chair Man Group says. What's the Man Group? It's a group of man. I don't know, but it's pretty big, I guess. The Federal Reserve may have to turn to quantitative easing to lower long-term borrowing costs if bond markets start to question the independence of the next chairman, according to Man Group. Really, it has nothing to do with the next chairman. All it has to do with is the fact that they have stopped QE, and that is not good for the banking system because they trade trillions of dollars in quantitative easing dollars every day in the repo market. But let's go to the second paragraph here. Investors only have to look at what happened in the UK. Look at that again. They're using the same analogy. When traders sold off gilts in 2022 due to a lack of confidence in the economic policy of then Prime Minister Liz Truss.
We're going to truss all up underneath.
Tight.
See, so it's going to be like a big sausage.
Said Christina Hooper, chief market strategist of the world's largest publicly traded hedge fund group. And I guess the world's largest publicly traded hedge fund group is Man Group. It's kind of ironic that the head of Man Group is Christina Hooper, who is the chief market strategist, who is probably not a man, but these days you never really know. Now, the point is you have two articles, one from the Wall Street Journal, one from Bloomberg, saying that bond markets are about to have a Liz Truss moment, where what happened in the UK at that time was that gilt yields skyrocketed because the bond market was losing confidence in the ability of the UK to pay back its debt, which is what cued the Bank of England at that time to buy a whole bunch of bonds. And they're saying this could happen both in the Fed and in Japan, because the bond markets are not going to want to fund all this spending, so the central banks are going to have to pick up the tab. And of course, that is going to lead to massive consumer price inflation as we start the final money printing round. Now, here's my thesis. Once we start this final money printing round, which is already being hinted by the Wall Street Journal and by Bloomberg, what happens next is that silver starts to break out. So this is the short term, relatively short term trend line of the gold to silver ratio. You can see here I drew a trend line from the 2011 bottom at 30 to 1. I wrote about this at the Endgame Investor on Substack. Check the link in the description below if you want earlier reports on this stuff and more written form, and actually better because I'm a better writer than I am a podcaster, whatever this thing is. So we see here 2011 30 to 1 level, and we have a trend line that was established back in 2021 and hit again in 2024. And finally, it was broken just I think it was 2 weeks ago, and now we are at 72.18 gold to silver ratio. So this trend line has been broken, and we could head much lower, and I think we will head much lower in the gold to silver ratio. Maybe we'll have to retest this trend line from the bottom as resistance instead of support, and then we will head down towards 30 again. How fast, I don't know exactly, but here is the long-term chart that shows that the gold to silver ratio has hit 15 to 1 three times in the modern era before. We're talking about the Federal Reserve era, I guess. This is the pre-modern era, you could say, where the gold to silver ratio was around 15 to 1 straight from about 1718 to about 1880. Right? This is 1873. This is when the dollar went off the silver standard, and that is when the silver started falling in value. The falling silver value is shown by the rising blue line in this chart, but we did hit 15 to 1 three separate times. Once in 1919, at the end of 1919, right after World War I. That was because of a monetary inflation of World War I. Also in 1968, at the fall of the London gold pool, and in 1980. It's not just 1980, it happened three times. And you can see here there's like this imaginary line that this cannot go through, because this really is the natural monetary ratio of 15 to 1. Why is it exactly that? I don't know exactly why it's 15 to 1 or 16 to 1 or whatever it is, but that's what it is, and that's what it has always been. Not always, but most of the time for recorded economic human history. So the basic thesis of this video is that when bond markets fall, and we're going to see it in Japan, we're going to see it in the Fed, we're going to see it in the UK, that's what all these mainstream articles are saying. Their banks are running out of money to trade every night in the repo markets, and everyone's talking about a Liz Truss moment, and there's too much spending going on when the value of the bonds that back the money fall because the yields keep going higher and higher. The only thing left in the fiat system that has any real value or the real assets, that is the gold that remains backing any of these currencies. And you could argue that there isn't, but I still think there is some, and that gold has to replace the purchasing power that is lost by the bonds. And that is when the public can no longer afford gold, so instead of gold they go for silver. And if silver hits backwardation during that time, which it will, there is no way out of that backwardation because no one is going to sell silver for dollars in that state, as the value of dollars and all the currencies that dollars back, including the yen and the British pound and all the other ones, they fall in value and nobody sells their silver. Therefore, there's no way out of the silver backwardation, and the entire system reverts from being dollar priced to being silver ounce and gold ounce priced. And that, my friends, is the end game. Before this happens, you might want to get a Dirty Man safe. Link at the description below. Use the code ENDGAME10 at checkout for 10% off. Take some of your stacks, put it in there, put it somewhere on your property, and store the rest with Keith Weiner of Monetary Metals for a yield on gold and silver in gold and silver terms. Link at the description below, and I'll see you guys soon.
Soon. How soon?